It really pisses me off that two numbers, the 10-year and the Fed's fund rate, control so much of our daily Welcome to the Hostile Takeover, where we demystify Wall Street in order to make you some money. We are here to get you rich smart, not get you rich quick. My name is Rob. I'm a former mergers and acquisitions attorney at a top 10 New York law firm, a former faculty member at a top 8 business school. Most importantly, I've been trading these markets for 25 years and I am self-taught. I want to help make you some money to pay off those car loans, to pay off those student loans, and to help you buy your first house. So join us today and we're going to make you some money. You are getting killed by interest rates and you might not even know it. Your credit cards, your car loans, your rent, even your Netflix subscription are going up largely due to interest rates. But which rates matter? And more importantly, what can we do about it? In today's video, we are going to break down the 2 interest rates that matter the most in your daily life. And then more importantly, at the end, we're going to go on the offensive. I'm going to teach you some ways to combat those rates and make some money even if prices are going up. So let's get started.
They might not be satisfied with the small return they can get from U.S. government bonds. They might choose to buy stocks instead.
But climbing Treasury yields also signal that borrowing...
This is what's impacting you right now, the Treasury yields climbing.
It's basically a proxy for longer-term interest rates. If you want to get a rough sense of...
Meaning things are going to get a lot more expensive.
Where your mortgage rates are going to be going, you might look at the 10-year Treasury note and its yield.
All right. He just mentioned the 10-year Treasury. Let's make this really simple. The Treasury is a bond. A bond is an IOU from the government, meaning the government is borrowing money from you.
It's my money and I need it now!
A 10-year Treasury means that they are borrowing that money, that bond, over 10 years. Now, I don't know about you, but I'm not going to lend the U.S. government money unless I'm getting something in return. And that's everybody else as well. So the interest rate is the amount of money that gets paid back in addition to paying on the debt. So in other words, if I've got a 5% interest rate on a $100 debt, I'm going to make the $100 back plus $5 per year, 5%.
This is the way.
So how is it what the government pays out has any impact on what it costs me to buy a house? I'll tell you. Most of us cannot afford to buy a house with cash. We need to borrow money. Usually that money is borrowed from a bank. Banks need to get paid as well when they're lending out money, just like you need to get paid when you're lending the government money. The banks calculate how much they get paid, that's the interest rate, based on what that 10-year Treasury interest rate is at. So if a bank charges 2.5% above the 10-year Treasury rate, and the 10-year Treasury rate is at, let's say, 4%, a bank is going to charge you 6.5% for that mortgage. But let's say the Treasury rate goes up to 5%. Now, the bank is going to charge you 7.5% for that same mortgage. Your monthly costs are going to increase because the 10-year Treasury is increasing. Rising mortgage rates make home ownership much more expensive, but it also makes renting more expensive in 2 main ways. First, as interest rates increase, the cost of buying a house increases. As the cost of buying a house increases, that means that a landlord needs to charge more money to rent out the property in order to break even. That's going to increase your rent. The second and more subtle way is that as the cost of home ownership increases, more people are forced to rent. That means there's more people trying to rent in a market, and that's going to push up price. Remember, simple economics. If we're holding supply steady and we're adding to the demand, it's going to push up the price. So the 10-year Treasury has a huge impact on not only buying a house, but on your day-to-day rental costs. Similarly, the 2-year Treasury has an impact on auto loans. The greater the 2-year Treasury climbs, the more you're going to pay to borrow money for a car. Now, in all fairness, your credit rating has a much bigger impact on what you're going to pay on a car loan. However, though, it is important to keep that in mind. The bottom line is that the Treasury rates, remember the bonds, the IOUs from the government, impact your day-to-day life in ways that you haven't even thought of. And it is a good idea to keep an eye on them and what they're doing.
Bond yields aren't just watched by economists and investors. The Federal Reserve keeps a close eye on them as well. And they're not
These
just
are the
watching.
people that
Bond yields
control
are
us
a
all.
key part of
These are
monetary
the master of
policy
puppets.
that the Fed
These are the
uses
people
to help
pulling the
influence
strings.
the economy.
There's been an underlying
That man
sense of an
has
improved
more
economic
impact on
outlook,
your
and
life
that has to
than
be
you
part
have
of
any
why
idea of.
rates would move back up from the extraordinarily low levels they were at.
That's the chairman of the Federal Reserve.
The Federal Reserve, or the Fed, is a unaudited, largely unregulated central bank that the United States government permits to control our daily lives. The Fed's policies impact everything from the interest that you pay on a credit card to the price that you pay for a burger. The Fed is what is known as a central bank, meaning that it lends money to other banks. So think about it this way. The Fed will lend money to Bank X at 3.5%. Bank X then will lend you money at 6.5% and keep the 3% difference. That's how banks make money. So when the Fed decides to raise its interest rates, the rates that it charges to banks increases. But also the rates that the banks charge to you increase. There's something known as the prime rate, and you'll hear this all the time. The cost of the interest that you're paying is prime plus 4%, prime plus 5%. So prime generally is 3 percentage points above whatever the Fed funds rate is. So if the Fed funds rate is 3.5%, your prime rate is 6.5%. Now, most credit cards charge prime plus a 15% markup. So your APR, the interest that you're actually paying on a credit card, is going to be 6.5%, which is the prime rate, plus 15%, meaning you're paying 21.5% on that credit card. If the Fed were to drop rates, your credit card rates go down because the prime rate goes down. Even if you don't use credit cards, and I highly recommend that you don't, because those interest rates will kill you, you are still impacted by the Fed funds rate. If you subscribe to Netflix, listen to Spotify, or even eat a burger, you are hit by the Fed funds rate. Let me explain. Do you remember back in 21 when interest rates were near zero? Everything was cheap for borrowing. Well, it was cheap also for these companies to borrow. That allowed these companies to keep their prices down. But when we get into 23 and 24, interest rates start to rise. That means the company's borrowing costs start to rise. That means those companies have to pass those rising costs onto you, the consumer. That's one of the reasons we've seen inflation. Clearly not the only reason, but it is one of the reasons that life is not as affordable as it used to be. So the Fed has a daily impact on us, and yet many of us have never even heard of the Fed before. The old adage on Wall Street is that you can't fight the Fed. And that's very true. You never fight the Fed, meaning you never go against what the Fed is doing. But even though you can't fight the Fed, you can profit from it.
Money, money, money.
Rising interest rates make life less affordable for all of us. Instead of enjoying life, we're constantly on the defensive trying to pay our bills. Well, I want to put us back on the offensive. I want to show you ways to make money and make yourself a little bit more comfortable, even though interest rates and the cost of living is rising. ETFs, or exchange-traded funds, are nothing more than a bunch of assets packaged together and sold on an exchange. Think of it like a bag of M&Ms. You buy the bag at the store, but the real value that you get are the M&Ms inside.
Yeah, thanks for introducing
ETFs
us.
pretty much works the same way. And just like M&Ms, there's different types of ETFs. M&Ms, you may have a mint M&M, you may have the peanut butter flavor, or you may have the traditional. ETFs work the exact same way. And there are certain ETFs out there that are designed to make money when interest rates are rising. The floating rate note ETF will rise in value and in yield as interest rates rise. So as your cost of living increases, so will the payout. The next type of ETF are the inverse Treasury ETFs. These are high risk and highly volatile, meaning that as interest rates rise, these will rise fast.
Oh, wow.
However, as interest rates fall, these will fall fast. So if you're not sure interest rates will be rising, stay away, because you're going to find yourself losing your ass on this. But these two types of ETFs combined can give you a nice cushion against rising interest rates. You don't have to be a victim of interest rate rising, but you do have to do your homework on these ETFs. Like any other investment, these do carry risk. But if used properly, they can offset inflation nicely. It really pisses me off that two numbers, the 10-year and the Fed's fund rate, control so much of our daily lives. It controls where I sleep, what I eat, what I drive. There is nothing more indicative of a rigged system than a shadow bank that controls so much of the daily life. But you know what? We're not going to piss them on the takeover. We're going on the offensive. That's where those ETFs come in. They are going to hedge against inflation. They are going to make money in an increasing interest rate environment. Now, I'm not a fool. I'm not an idiot. I'm not going to sell you something that isn't true. These steps will not solve your affordability problems. But what I hope they will do is alleviate, even if slightly, some of that pressure that you're feeling from the affordability crunch. Give you a little bit more of a cushion. And if I can accomplish that, well, we've done a great thing. Thank you so much for watching today. I hope you've enjoyed it. I hope you found it valuable. And if you did, I hope you will consider liking and subscribing. Until next time, we'll see you.